Welcome to the Deep Dive, where we cut through the noise and get straight to the knowledge. Today, we're plunging into Rheinmetall AG, trading as ETR RHM on the Frankfurt Stock Exchange. Yeah, a company that's really at the very heart of a pretty dramatic global shift right now. In a world that's, rapidly reevaluating its security, we're exploring a monumental question. Is Rheinmetall transforming from just another industrial firm into, well, an absolutely indispensable arsenal for Europe's future? We'll try to uncover if the current boom is just a temporary blip, or if it's a fundamental multi-decade reset in its path and its valuation. This deep dive is anchored to data as of September 6, 2025. Shares closed at 1,744 in this company. What we're ultimately grappling with is this. Is the market currently underestimating the true long-term earnings power of this company, even despite its already significant run-up? By the end of our conversation, you'll hopefully have a clearer perspective on that.
Absolutely. And we've structured this deep dive into two parts. In part one, we'll lay the groundwork, we'll dissect its core business, take a look at its leadership, and dive into the financials.
Okay, and then in part two, we'll shift focus. We'll look at market sentiment, ownership structures, and a thorough risk assessment. That'll all culminate in our overall conclusion and an estimated intrinsic value range. So let's unpack this. Chapter 1, Business Analysis. Right, let's kick things off with core business understanding. Rheinmetall, it's an integrated technology group, but its identity today is, well, overwhelmingly focused on its defense sector.
Yeah.
That's really where the significant growth is coming from, isn't it?
Exactly. I mean, while they do still have that legacy automotive components division, Power Systems, which is more cyclical, maybe weaker, the defense sector is now the clear powerhouse. And we can break their defense business down into sort of key pillars. First, you've got vehicle systems, think heavyweight stuff, main battle tanks, armored personnel carriers. The NATO platforms, basically, their sales nearly doubled in early 2025. Then there's weapon and ammunition. This is critical. And high margin, too. We're talking about a 19.3% operating margin early 2025. They're a global leader here, especially in things like 155mm artillery shells. Huge demand. And finally, electronic solutions. This is more the high-tech focus. Air defense, command and control, battlefield digitalization, seeing really robust growth, particularly from German military modernization.
Okay, so it's not just about selling a tank once and that's it. Their model seems built around these long-term government contracts, decades long, often within NATO.
That's the core of it. It provides really predictable recurring revenue. You've got the initial sales, sure, but then upgrades, maintenance, and of course the constant need for ammunition. The defense sector overall boasts a, 12.4% operating margin? Pretty healthy.
And that whole one-stop shop idea sounds key.
It is. For land warfare especially, providing the tank, the turret, the gun, the fire control, the ammo, even training and maintenance. It's a massive value proposition. And their ability right now to scale production and expand capacity faster than competitors in this high-demand environment, that really sets them apart.
And the scale itself is quite remarkable.
Oh, definitely. They are Europe's, preeminent supplier of army technology, a globally significant player. Get this. Their order backlog hit a record $63 billion as of mid-2025.
$63 billion.
Yep. That gives them over 5 years of revenue visibility, which is, well, truly exceptional in almost any industry. They even got promoted to Germany's main stock index, the DAX, back in March 2023. Sort of solidifies their status.
Right. Building on that, let's look at the industry analysis. We keep hearing this term supercycle in defense spending. What does that actually mean for Rheinmetall on the ground?
It means we're likely in a structural, long-term realignment of government priorities. It's not just a temporary blip caused by recent events, it seems more fundamental. European defense budgets, for instance, are projected to grow at nearly 7% annually through 2035. That's actually outpacing the US and China. Europe's share of global defense spending expected to rise quite a bit, maybe from 16% to 22% by 2030. For Rheinmetall, just in land-based systems for Western countries, that translates into something like a greater than $300 billion opportunity through the early 2030s. It's huge.
Okay, that really puts the scale into perspective. So who are they up against? Who are the main competitors in this space, and how does Rheinmetall sort of stack up?
Globally, you're looking at companies like BAE Systems from the UK and then the US giants, General Dynamics, Lockheed Martin, Northrop Grumman. But what's interesting is that it's not always pure competition. You see a lot of co-opetition, like Rheinmetall is collaborating with Lockheed Martin on the GMAR system. Now, valuation is really critical. Rheinmetall trades at a substantial premium compared to these peers. Its price-to-earnings ratio, the PE, was around 92.97 at our analysis date.
93. compared to what for the others?
Well, BAE Systems was around 26.5, General Dynamics about 21.7.
Yeah.
So yeah, a massive difference. And that's really the core of the investment debate, isn't it? Do its growth prospects and strategic position truly justify that kind of premium?
And this industry is just packed with regulations, which must create some serious barriers to entry, right?
Absolutely. It's one of the most heavily regulated sectors out there. You've got strict national security rules, export controls from the German government, foreign investment reviews. But these regulations, combined with the, frankly, massive capital investment needed for R&D, factories, machinery, plus the long, complex sales cycles with governments, and the need for specialized expertise and trust built over decades, all that creates an incredibly high competitive moat. It makes it extremely difficult for new players to just jump in. It secures revenue streams for, 30 or 40 years per platform once you win a contract.
So those barriers, they almost become a key competitive advantage in themselves. What else gives Rheinmetall an edge?
Well, their brand strength is huge. A 135-year history. Made in Germany still means a lot in terms of quality and reliability, especially in defense. That's invaluable. Then, as they ramp up production for that enormous backlog, they get significant economies of scale. Spreading fixed costs lowers the per unit cost. They can potentially expand margins or even lower prices a bit, reinforcing their dominance. The switching costs for militaries are just immense too. Once you adopt a major platform like a Leopard tank, you're investing in a whole ecosystem: training, maintenance, integration. It effectively locks in customers for decades. And finally, their unique assets. Things like being a single source supplier for integrated air defense systems, from the fire control right down to the specialized ammo. Plus their investments in next-gen tech like high-energy laser weapons. That all helps solidify their lead.
Chapter 2, Management Evaluation. Okay, so with that clear picture of the business and the industry landscape, let's now turn to the leadership assessment. Who's actually steering the ship through this really pivotal time?
Yeah, the CEO is Armin Paperger. He's a company veteran, been there since 1990, took over as CEO in 2013, so deep institutional knowledge. And his track record, looking back, shows some pretty remarkable strategic foresight. He was already restructuring Rheinmetall for a more, let's say, contested geopolitical environment before the 2022 Ukraine invasion. He's become quite a prominent public figure in Europe's whole rearmament discussion, engaging directly with Ukrainian leaders, overseeing this massive expansion in production capacity.
That level of, decisive crisis response is certainly noticeable. What about transparency? How open is management with investors?
They seem quite transparent, actually, particularly with what they call nomination potential. That's over $80 billion in official government intent for future orders. Not firm contracts yet, but a strong pipeline indicator. It gives investors a much clearer view of potential future growth. And what's also really compelling, I think, is the significant insider buying lately. Paperger and other executives bought over $2 million worth of shares in the last 90 days.
2 million.
Yeah, and Paperger himself accounted for over 1 million of that. That sends a really powerful bullish signal, doesn't it? Suggests that the insiders, the people who know the company best, believe the market might still be understating the future potential.
That kind of insider confidence definitely speaks volumes. Leads us nicely into their capital allocation. How are they putting money to work, investing in growth?
Well, their number one priority seems to be aggressive reinvestment right back into the core defense business. They're currently building or expanding something like 10 major factories. That new ammunition plant in Unterlüß is a key example. Their M&A strategy looks very targeted too, focused on boosting core competencies, like acquiring X-Ball systems in Spain for $1.4 billion that massively increased their ammunition production capacity. A really critical strategic move given the current demand.
Okay, so focus is on internal growth and strategic M&A. What about returning capital to shareholders? Share buybacks versus dividends.
They have authorization for buybacks up to 10%, I think, but they haven't really exercised it significantly. It seems management clearly prioritizes reinvesting in the business because they see superior returns from growth right now, given that huge order book. But on dividends, they actually have a strong growing policy. They proposed €8.10 per share for 2024. That's a big jump, over 42% increase. Yeah, it marks 4 consecutive years of increases. The 5-year compound annual growth rate is around 28-30%. And it looks sustainable. The payout ratio is about 45%, so they're still retaining plenty of capital for that growth investment we talked about.
Sounds like they're being pretty good stewards of capital then. How does that translate into their return on invested capital as when actually creating value?
It certainly seems so. Their current ROIC is an impressive 14.83%. That actually outperforms something like 88% of their industry peers. And what's even better is the trend it's rising. That 14.83% is higher than their 3-year average of around 11.9% and their 5-year average of about 10.8%. So it indicates their aggressive growth investments are actually improving profitability and efficiency. And crucially, their ROIC is well above their weighted average cost of capital, their WACC, which confirms they're creating substantial economic value.
Chapter 3, Financial Analysis. All right, let's dive into the numbers with the key metrics review in our financial analysis. As of our analysis date, September 6, 2025, Rheinmetall AG had a market cap of $80.28 billion. Puts it firmly in the large cap space. So what do the revenue growth trends tell us?
Well, the revenue growth shows really powerful acceleration. It's almost doubled since 2020. They saw a massive 36% jump in 2024 alone. The trailing 12 months figure up to June 2025 was over 10.6 billion. And the strong double-digit growth, it's pretty much expected to continue, fueled by that enormous backlog we keep mentioning. And importantly, this growth is translating into robust and improving profit margins. Their operating margin, for example, hit 13.9% TTM, which is better than nearly 80% of their peers. Pretty strong.
That kind of acceleration is definitely striking. What about free cash flow, though? Sometimes that tells a different story when a company's growing so fast.
It does, and that's a really key insight here. Free cash flow has fluctuated. Yeah, it even went negative back in 2022. But paradoxically, maybe this is actually a powerful bullish indicator in this case. It's a direct result of their explosive growth. They're pouring capital into working capital, inventory, receivables, and CapEx, building those factories to meet the demand represented by that massive backlog. The expectation is that free cash flow will rebound strongly as large advance payments start coming in from those big long-term contracts.
Okay, that's a crucial distinction. Good context. Moving to financial stability, how consistent have their earnings been over, say, the last 5-10 years?
Well, after a bit of a dip in 2020, they actually reported a small loss. Then the earnings show strong, accelerating growth. Net income went from about $335 million in 2019 to over $800 million in 2024. That's an impressive 5-year earnings per share compound annual growth rate of around 24.4%. And their balance sheet, it's remarkably healthy, especially given the growth. Their debt-to-equity ratio is very low at just 0.41, or about 41%. What's truly remarkable, I think, is that this ratio has actually decreased over the past 5 years, even with all the aggressive growth and acquisition.
It went down while they were growing that fast.
Yeah. It signals really outstanding financial management. It suggests they're financing a lot of this growth through internal cash generation rather than piling on excessive debt.
That's definitely a sign of a very well-managed company. Okay, now for the 80 billion euro question. Valuation analysis. How does that PE ratio stack up against peers and its own history? We touched on it, but let's dig in.
Right. So that trailing 12-month PE ratio, as we said, is around 92.8. And yes, that is significantly higher than its own historical averages and its peers, which tend to hover in the, 22 to 26 range. It absolutely reflects extremely high market expectations for future earnings growth, no doubt about it. However, the forward PE, looking ahead, drops quite significantly to about 48.0. That indicates analysts expect very rapid earnings growth in the coming year. And maybe even more importantly, the PEG ratio, that's price earnings growth, is around 1.12. Generally, a PEG around 1 suggests a reasonable valuation relative to growth prospects. So 1.12, while not super cheap, suggests the valuation might be justifiable given those exceptional growth forecasts.
Okay, so despite the sticker shock of the high PE, the growth context makes it look potentially more reasonable. For a different view and an intrinsic view, can you briefly explain the discounted cash flow, or DCF, concept for our listeners?
Sure. So a DCF analysis basically tries to figure out a company's intrinsic value, its true fundamental worth, based on the cash flows it's expected to generate in the future. You project those future free cash flows out maybe 5 or 10 years, and then you discount them back to their present value. You have to account for the time value of money. A euro today is worth more than a euro tomorrow, and also the risk involved. It's really an attempt to look beyond the day-to-day market sentiment and estimate what the business itself is truly worth. Synthesizing various professional analyst models, our estimated intrinsic value range for Rheinmetall AG comes out somewhere between 1,700 and 2,300 euros per share.
Okay, 1,700 to 2,300 euro. What are the key assumptions driving a DCF model like that? What are the big levers?
Well, the primary drivers are definitely the projected growth rate for those cash flows and the discount rate, which is often the weighted average cost of capital, or WACC. For Rheinmetall, analysts are forecasting a revenue compound annual growth rate somewhere between, say, 20.9% and 24.2% through 2032. Then usually a more conservative long-term terminal growth rate after that, maybe 2.0%. The WACC, the discount rate, reflects the company's cost of capital blending debt and equity cost. For Rheinmetall, it sits at about 7.8% in these models. That's influenced by things like the current risk-free rate, maybe the German 10-year bond yield at around 2.7%, and an equity risk premium for Europe. But importantly, Rheinmetall's proven stability, reflected in its low beta of 0.56, meaning it's less volatile than the overall market, helps keep that cost of capital reasonably low.
Chapter 4, Market Sentiment. Okay, great foundation. Let's move into part 2 now, starting with market perception. What's the general feeling out there? What's the word on the street from analysts?
Well, the sentiment is overwhelmingly bullish. You look at the consensus of, I think it was 13 analysts covering the stock. The average 12-month price target is 2,102. The high target is up at 2,280, low around 500 and 650. And the consensus rating is a firm, strong buy. The general media tone is also exceptionally positive. It's just dominated by headlines about major contract wins, new factories opening, strategic partnerships like the one with Lockheed Martin. The CEO, Patrick Digger, is frequently quoted talking about the demand and this long-term defense cycle.
Right. So beyond the news and analyst ratings, what do the actual market indicators tell us? Like short interest. Is anyone betting against this?
Very few, it seems. Short interest is extremely low, less than 1% of the total capitalization. That indicates very little bearish conviction among sophisticated investors. It suggests the bullish story is pretty widely accepted right now. The share price itself is also showing strong momentum. At our analysis date, $1,744.50 was slightly above its 50-day simple moving average of about $1,720. That signals positive short-term momentum, and perhaps more importantly, it's significantly above its 200-day moving average, which is down around 1,301. That confirms a really strong, durable, long-term uptrend is in place.
Chapter 5. Ownership structure. Okay, makes sense. Now let's look at the ownership structure. Who actually owns Rheinmetall shares?
Is it mostly institutions?
Individuals.
Yeah, its shareholder base is definitely anchored by blue-chip global institutional investors. That lends significant credibility, I think. You see names like BlackRock holding nearly 7%, Vanguard around 4%, UBS Asset Management over 3%, Capital Research, Fidelity. The big players are involved. Now, while the overall percentage held by insiders isn't super high, that pattern of recent transactions we discussed earlier is profoundly significant. Remember that $2.16 million in net buying over the past 90 days?
Right, with the CEO buying over $1 million himself.
Exactly. That sends such a powerful bullish signal. It strongly suggests that the insiders, the people who arguably know the company's prospects best, believe the market is still undervaluing its future potential even after the run-up.
And is ownership very concentrated, or is it widely distributed among many holders?
I'd say reasonably concentrated. The top 25 shareholders hold about 36% of the company. However, there's also a very high free float. The shares readily available for trading at around 84%. So that ensures ample liquidity for investors wanting to buy or sell. No issues there.
Chapter 6. Risk assessment. All right, let's pivot to risk assessment. Every investment has risks. Let's start with a classic SWOT analysis. What are Rheinmetall's core strengths and weaknesses?
Okay, strengths are pretty clear by now, I think. Diverse and comprehensive product portfolio, particularly in land systems, technological leadership, that unprecedented revenue visibility from the $63 billion backlog, their embedded position within NATO supply chains, and, as we just discussed, strong, aligned management with significant skin in the game. For weaknesses, well, there's obviously a dependence on government budgets. Those can shift with political wins, though the current trend is strongly favorable. The complex regulatory and political hurdles are always a factor in this industry, and maybe a potential risk of margin dilution if they were to expand aggressively into lower margin adjacent markets, though their focus seems squarely on defense right now.
Got it. And the opportunities for growth, they seem pretty substantial.
Oh, they're truly massive. The biggest is that structural European rearmament cycle we talked about that's a potential multi-decade tailwind. Then there's major potential in the U.S. market. They're a finalist for the Army's XM-30 infantry fighting vehicle replacement that could be worth up to $41 billion, and also the Common Tactical Truck Program, potentially another $14.5 billion. Winning even one of those would be transformative. Plus, just the basic need for ammunition restocking across NATO. Germany alone estimates it needs until 2031 just to replenish its stocks. That dynamic is playing out everywhere. And finally, there are probably opportunities for further consolidation and expansion within the still somewhat fragmented European defense market.
Those are some seriously large numbers. Okay, what about the flip side, the key threats?
Well, the most significant, though perhaps unlikely in the near term, would be a sudden, lasting geopolitical de-escalation. A genuine, durable peace breaking out would fundamentally alter the growth outlook, wouldn't it? Then there's execution risk. They're undertaking a historic level of capacity expansion. There are inherent risks in managing that potential delays, cost overruns, maintaining quality control at that scale. Competition, particularly from the big U.S. defense primes who benefit from the massive U.S. budget and foreign military sales program, is always a factor. And looking further out, there's the threat of technological disruption. Could things like autonomous drone swarms eventually reduce the relevance of traditional heavy platforms like tanks and IFVs? It's something to consider long term.
That makes sense. How do broader macroeconomic factors play into this? Things like inflation or maybe those hypothetical U.S. tariffs we heard about possibly coming in 2025. Does that impact a company so tied to national security?
Interestingly, it seems Rheinmetall is largely insulated from a lot of that. Take inflation. These are typically long-term government contracts, often with clauses allowing for cost pass-through. Plus, the demand driver isn't consumer sentiment, it's national security. Governments are increasing real defense spending, accounting for inflation. Even something like hypothetical U.S.-imposed tariffs, say 15% on EU industrial goods, it appears manageable. First, there's often precedent for exempting strategic defense and aerospace products from these kinds of tariffs. But more importantly, Rheinmetall is being proactive. They're onshoring production specifically for the U.S. market, like their acquisition of Lock Performance. This helps bypass potential tariffs and actually makes their bids more politically attractive in the U.S. They're almost turning a potential threat into a competitive advantage.
Chapter 7.
Conclusion. Okay, we've covered a tremendous amount of ground today. Let's try to bring it all together in our final synthesis of findings. Can you quickly recap the core of the bull case for Rheinmetall? Why would someone be optimistic?
Sure. The bull case is really compelling, I think. You've got a generational growth story here. Rheinmetall is arguably the primary European beneficiary of a multi-decade rearmament cycle, a structural shift, not temporary. They have unmatched revenue visibility with that record $63 billion backlog, plus potentially another $80 billion in the pipeline. They hold a dominant market position in critical land systems and ammunition, protected by extremely high barriers to entry. You have exceptional and aligned management led by a visionary CEO with a proven track record and significant personal investment. And underpinning it all is a fortress balance sheet with low leverage despite rapid growth. It suggests this isn't just a cyclical bounce, it feels like a fundamental reset for the company.
That's a powerful argument. Definitely lays out the optimistic view. But what about the key bearish points? What are the main risks or reasons for caution?
Well, the bear case really centers on valuation risk. That high PE ratio we discussed reflects extremely optimistic expectations baked in. It requires near flawless execution to justify. Any significant misstep could hit the stock hard. There's also that geopolitical dependency. The whole investment thesis really relies on the continuation of the current geopolitical environment. A sudden, lasting de-escalation, however unlikely it seems now, would significantly alter the outlook. And related to the first point, there's execution risk. Managing this historic capacity expansion carries inherent risks, delays, cost overruns, quality control issues. They have to deliver on these massive orders efficiently.
Okay, so